Welcome back to the Market Insights webinar. It's Kevin Prince from BMO ETFs. We're so pleased that you join us each week for some insights to the overall marketplace. You know, these sessions have been building since this crisis started, and it's really because of you, the listeners, who come back each week and, more importantly, give us some questions. Because those questions you provide us, and we're going to answer some at the end of this session here, those help us give us direction on the overall content we provide each week. So this week, very interesting topic. We thought we'd do this in advance of the US election because there's going to be potentially some volatility coming up. So really talking about this week, some important insights from the recent market correction in regards towards exchange traded funds. And we're going to be joined with the IIAC in 1 second. But first of all, let's get into the traditional disclosures. From a disclaimer's perspective, keep in mind that this is not recommendations and it's not advice. This is simply market insights to give you some general thoughts what's going on in the marketplace and some new perspectives out there, and education across the board. Again, thank you for joining us. Let me invite our guests in. Now, Todd Evans is coming in from the IIAC, and we're going to explain who they are in a second, but I'm going to highlight that he's been doing some papers in regards towards both fixed income and equities and how they performed as respective ETFs in the marketplace more recently. So we're talking about that a bit, as well as going to be rejoined by Mark Rays from BMO Exchange Traded Funds. Actually also wrote some papers on equities and fixed income ETFs and how they performed in the recent marketplace. So two experts with respect towards what ETFs did in the more recent marketplace. So let's spend a few minutes first and talk about some tools from the IIAC. Todd, let me bring you into this one and start off talking about on your website, and that's the IIAC.ca website. You have some thought leadership out there. Can you walk us through that?
Sure. Thank you, Kevin. The IIAC has two different websites. There's a member site and then there's a public site. In the public site, you have access to almost everything that you would on the member site. So it's a very useful site, and I would encourage everybody to go in and look around. Within the thought leadership that Kevin was referring to, we publish papers during the course of the year. A lot of our work is as an advocacy effort for capital markets firms that are members, but we do thought leadership in areas that are changing and important to market participants. And so this year we have, I'm the one that's does most of it. I've written two papers on ETFs. One is on fixed income and one is on equity. But I would encourage you to look at some of the other relevant thought leadership pieces. As well, we do have industry data on a tab that you can see on that page. And under that industry data, we collect data in a pretty unique way. And I think, again, I encourage everybody to take a look. Back to you, Kevin.
Thanks for that, Todd. And now, for everybody out there, let's give them a little background about what the IIAC is. I use the acronym, but it is the Investment Industry Association of Canada. Todd, walk us through what this group does.
Sure. And I'll go back in history because there was an organization that some of you may be familiar with. It was called the IDA, and it involved both an advocacy piece and a regulatory piece, and it was split apart because there was a bit of a conflict there. So the one piece that was the larger piece on the regulator side is IIROC, and IAC is owned by member firms, and it's I shouldn't say owned because it's a not-for-profit, and we advocate on behalf of capital markets firms and other member firms to regulators. That's our primary function, but we are a conduit for information as well.
Good background. Of course, I'd encourage everybody to take a look at the IIAC website too to get more information on that. With that, let's get into today's topic. And I think a nice way to bridge into today's topic is we're going to take a look at ETFs and how they perform in the more recent marketplace and the support they did during the more recent crisis. But let's give everybody a little bit of background first and foremost, a little bit of history on exchange traded funds. Now, interesting enough, we all know that the very first ETF was actually launched here in Canada, and we're quite proud that the ETF industry globally started right here in Canada. But interesting, we actually followed as Canadians at the time what was going on in the States, moved a little bit faster than they did. Sometimes we do that. And what they were looking at was in 1987, the Black Monday, that market crashed. And the thought of ETFs came out of that. Now, Mark, you've been in the ETF industry arguably more than 15 years yourself. Don't mean to state your age there, sorry. Can you talk to us a bit about that thought process back then and what it meant for the marketplace?
Sure. Thanks, Kevin, and thanks everyone for listening in again today. And that's okay. I'll take that age reference. It had to catch up to me eventually. Anyways, going back to the history of ETFs, it really did start back that far back, looking in the late 80s, early 90s. And ETFs were thought of as a tool that could help really address large market movements like the stock crash, and really add liquidity to the system, and really help as well individual stocks from that daily volatility that comes out from a lot of institutional trading. And that was the rationale back then, and it was interesting to see in, of course, March of this year that carried through again, and we'll get into that a little bit. But clearly the ETFs were brought into play, interesting enough, first as an institutional vehicle to add another layer of liquidity to the marketplace. So they started off institutionally. Of course, advisors and direct investors then became quite interested to them. And of late, we've seen a lot of heightened interest back again from institutions. So that's one of the most interesting things about ETFs. Is they really do appeal to any user group. So from a direct investor to the biggest institution, ETFs are a great tool to use, and overall provide this additional layer of liquidity that can really help out the market when it needs it. Thanks, Kevin.
Thanks, Mark. And I like to think that that basket of the ETF is what provides that liquidity in the marketplace versus an individual security at times. Now, Todd, you did some papers on this. We talked about that already. And certainly let's talk about, is that ETF and did that ETF provide some liquidity to the marketplace in the more recent correction? Give us some insights if you can.
Thanks, Kevin. Actually, this slide, I think, is a real eye-opener for some, and many of you may have experienced it, but when you look at it carefully, you realize that during the early days of the pandemic, there's a number of issues going on. One was the value of trading really spiked during the late February and into March and into April. And at that time, a lot of players in the marketplace needed liquidity, and ETFs clearly demonstrated that they were able to provide that liquidity. And there were some underlying issues that, in fact, weren't trading readily. So when we look at this, we see ETFs performing as hoped for. Kevin?
Thanks for that, Todd. And then, Mark, let's now look beyond the broader ETF market. Let's take a little look inside the ETF market, and actually in the context. But we saw what's going on in the overall fixed income universe itself. There's certainly some challenging times. Give us some context what's going on in the ETF market relative to the broader fixed income market at the same time.
Sure, thanks, Kevin. And it certainly was a challenging time for the entire fixed income market. And what you saw essentially is a vast majority of the fixed income actually went no bid. And by what I mean by that is essentially market makers, dealing desks stopped transacting in these bonds. So the whole market essentially froze up of the underlying bonds. This is probably felt the heaviest in corporate bonds, but interestingly enough, also impacted, provincial bonds, federal bonds, even short-term instruments as well. So the entire market really froze up on on the volatility in the marketplace. And as equity markets fell and people wanted to potentially rebalance and fund that portfolio, they were looking to sell fixed income. So the market became quite one directional as a sell on fixed income, and the underlying bonds weren't trading. So what ended up happening is the ETFs, which have that additional layer of liquidity with ETF market makers, with direct buyers and sellers like you and I, the ETFs actually kept trading and provided price discovery. And what I like to say there, and mention it off the top, is they provided liquidity when liquidity was needed. So was there a cost to that liquidity? Yes, the prices were falling, spreads were getting wider, but they continued to trade when the underlying market didn't. And that is a great feather in the cap for ETFs to show that they've got this additional pool of liquidity. And what everybody questioned was that relative to the NAV, there got to be a discount of the traded market price. But that didn't actually mean there was something wrong with the market price. It actually meant with the NAV, which is provided based on dealer quotes, because remember, these are OTC instruments, bonds don't trade on the exchange. The NAV was actually pretty stale, because if you look at a period where markets are falling quickly and those NAVs aren't falling or not moving at all, that's really telling you that there's a bit of a dislocation there. And the market price was far more reflective of what was actually going on in the marketplace, albeit prices were falling and spreads were getting a little wider. But overall, the ETFs really provided a clear benefit of liquidity and trading when investors needed it. Thanks, Kevin.
Oh, thanks for that. I think that's valuable insight, especially about the net asset value and the dislocation there to the net asset value relative to the price, but the price itself being kind of that key determinant of actual real liquidity, and you were able to get out where the other one had been a stale data set. Todd, let's talk to you about spreads and what you saw going on, the fixed income spreads at the same time, and if you can give us some background there.
Sure. And bid offer spreads, certainly there was a period of time where we did see the bid offer spreads widen out, but it's important, and for ETFs, but it's important to understand that this also occurred in the underlying market itself. And as Mark indicated, there were in fact certain products that basically went no bid. So the ETF was the product that was actually able to provide liquidity. And also there is a credit component depending on the composition of the ETF, and that credit component will also generate a little bit of uncertainty in terms of the product and a slightly wider spread. And to me, what's impressive is how quickly, after some volatility, that we see the spreads actually came back pretty close to where they had been previously. So that little period of stress, it was there for the entire market. It was there for ETFs, but ETFs continued to trade throughout. Back to you.
Thanks, Todd. Now, maybe I'll just stay with you for a second. What are some of the lessons learned in the fixed income aspect relative to ETFs in that last correction?
So maybe I'll start, and then Mark, you can finish. But we did see that there was a time where there were people that needed to pull money out of the off the table, and ETFs provided that ability to do so. And Mark, do you want to elaborate some more?
Sure, thanks, Todd. There was just a slide up, Kevin. You can go back one on our aggregate bond ETF.
No
and I don't normally show when we have outflows, but actually happy to do so here because this is really a validation that we saw significant money coming out of this ETF in March. And people thought that potentially that could be an issue with ETFs if trading became one directional. But happy to report as a lesson learned that even with that one-sided trading, the spreads, the pricing of this ETF continued to be actually quite tight and very effective in the marketplace. So it's another proof point that kind of puts to bed this whole idea that ETFs can really harm the market. Quite contrary, they add liquidity and they're able to absorb significant one-way flows. So let's go to the next, Kevin.
No problem.
Thank you. So a few lessons learned, a few things to keep in mind. Certainly the first one, and it's nice to say, and maybe it's not applicable for everyone, but if you don't need to trade into a high level of volatility, you're best off waiting. We did see a quick recovery in these ETFs, both in terms of spread and in price. So for those that were able to sit on the sidelines for a little bit, they certainly benefited from not stepping in front of that directional market. We do see wider execution. So I mentioned that spreads got a little bit wider. That just makes sense because, of course, the underlying market is topsy-turvy. So you'd expect, your bid and your ask to get a little bit wider. But here's an important one. Focus on the larger and more liquid ETFs in the marketplace. And this really came through during this correction period where, the larger, more liquid ETFs, like our aggregate bonds at AG or our Canadian equities at CN, they have natural pools of liquidities. They're known tickers with buyers and sellers that really enhance liquidity relative to the underlying. And having some of your portfolio in those tickers, again, is going to give you liquidity when you need it. And I know the whole ETF market will turn and talk to you about how ETFs can access the underlying liquidity, which is true and which is great. But when that underlying liquidity isn't there, these large, mature, liquid ETFs are a great place to find a relative layer of safety and tradability. Thanks, Kev.
That is a key insight there, because you're right. And good insight for everybody to think about. Think about large and liquid ETFs, especially as we navigate through these months ahead. Now, let's flip gears here. Let's talk about the equity side now, if we can, because we certainly talked about the fixed income side, and I think it really put to bed some myths that we used to hear in the past. But how did equity ETFs react in the overall marketplace in volatility? Let me go to you, Todd, on that one. I got a nice couple slides here.
Yes, it really held up very well during that crisis period. What this shows is that there were some of the ETFs, in fact, that really only had a slight blip in the spreads that were experienced, and there were some with composition slightly different that we did see some volatility in those spreads. But again, they've returned largely to normal, and at the time, as Mark was indicating as well, they often, for some of the ones that had components that were less liquid, they were providing price discovery and liquidity, where some of those underlying products, in fact, did not have those. So I think it's a very positive story. Back to you.
So let's look at the context now of the ETF and the equity side relative to total equity. And we talked about volume as we kicked off there with your chart. Let's talk about it specifically relative to equity volume here. And you got a nice overlay chart we'll bring up behind it.
So this is a real telling chart. The one thing that I really would take note is all volumes did increase during late February, early March, and ETFs as a percentage of that increased volume rose. So, clearly as another layer of liquidity, I think they performed incredibly well, and it's something to really, I think it's a very positive note to take, a very positive point to reinforce of the ETF market. Kevin.
Perfect. Now, Mark, just like you covered off some lessons learned on the fixed income side, can you share with us some lessons learned with ETFs on the equity side?
Sure. Thanks, Kevin. Well, one thing to really recognize again is, this wasn't an ETF issue. This was clearly a market issue. It was felt more in fixed income than in equities, but even equities got more volatile, more price changes, slightly wider spreads. But it was good to see the ETFs come through it. But just realize that the ETFs are really a recipient of that volatility. They're not causing it. And we've told that story before, but it's another clear indication here, validating that point. The second we spoke to performed well through the crisis, and the last is something we haven't spent too much time on yet, but I do find it quite interesting. There was a lot of rebalancing activity into the end of March. Of course, being a quarter end, a lot of people were looking to put their portfolios back to, the equity bond weights that they normally carry, which meant that you were selling a lot of fixed income and buying equities because, of course, equities had fallen much further. And that actually contributed well into this period of volatility. ETFs, of course, help make this rebalancing easier, but it's an interesting thing for people to think about within your own accounts. And again, when I spoke to, not trading into the volatility unless you really have to, those that were able to hold off, let's say, into the beginning of the next month, actually benefited quite a bit through that in terms of pricing, execution, and rebalancing their portfolio. So it was interesting to see with the volatility that came to be, how we continued to contribute to it as rebalancing occurred. Thanks, Kevin.
It's good to see too on the equity side, like the fixed income side, that the basket is, simply a very good liquidity source at these stressful times in the marketplace. And you're right. Sometimes you still want to think about rebalancing in the periods of time you're rebalancing too, but it does offer you the liquidity if you need it. Now, Mark, you mentioned a really good point there that you're right. This was not just a specific ETF aspect. It was a crisis across the board. And there was actually some implementation in advance of the crisis, some changes in regulations, and really gave some test of the overall financial market itself. Now, can you maybe talk to us about with this more speed of the correction, how that worked and those limits to the marketplace and the speed bumps along the way, how those help the market itself?
Sure. Thanks, Kevin. Well, I think the important thing to realize here is the exchanges have learned as well over the years, right? So if we go back to, the flash crash or some of other, more volatile events going back over the last, let's say, decade, exchanges really realized that during these periods, they need to slow the market down. So they put additional circuit breakers in place to help out during this period. Sounds fancy, but what it essentially means is when they hit certain price volatility trigger points, they actually just shut down trading for up to 15 minutes, just to let the market breathe, let all investors catch their breath and kind of step back and revisit where they are, and potentially slow down program trading. So that actually ended up happening 4 times early on in the pandemic, that we hit circuit breakers and actually paused out the market. And, looking back at it, we really do feel that helped contain some of the volatility. So that's quite important. There's other little things as well on the screen that you can see there, but to me, the key thing is that these circuit breakers that were brought into play really did do their job to slow down some of that price correction that was going on. Thanks, Kevin.
Thanks for that, Mark. And for those of you out there who want to dive into the circuit breakers, we actually ran a webinar like this, Market Insights, earlier on, probably April period, if I get it right there, on circuit breakers, and we had the TMX join us and go through in detail. So take a look at that. It's available on YouTube under BMO Market Insights. Take a look at that one. And then, Mark, as we head into the next week, there's potentially some volatility. Do me a favor, can you share some good trading tips with the audience?
Sure, thanks, Kevin. always avoid trading right at the open of the market. Just allow the ETF to come out of the gate. So I like to say avoid the first 10 minutes of the market. That just allows all the underlying securities in the portfolio to start trading, and so that the ETF price is as effective and as efficient as can be. Try to transact when the market is open. That's applicable to European. You'd want to trade international in the morning and not, close to 3 or 4 o'clock our time. Unfortunately, it doesn't help us with emerging markets, but keep that in mind for European. We always suggest using limit orders. That just makes sure you get the execution that you want. A market order is going to go right out, is going to get filled on wherever the bid and ask is. A limit order just allows you to execute at a level that you're most comfortable with. Just keep in mind, if you do place a limit and the market moves away from you, that you may have to revisit that limit during the day if you're really looking to get filled. And as we've been talking about all call, just be aware of what's going on in the marketplace. If things are really volatile, if markets are unstable, just realize what you're trading into. You might be doing that tactically to take advantage of things and get in at a low point. But if you are selling, just realize that you're selling into selling pressure, and therefore that might impact the price that you get. Thanks, Kevin.
Thank you, Mark. Now we're going to flip gears and we're going to answer some of the questions that came in this week. And again, thank you as an audience for sending us your questions. We really appreciate that. We try our best to get through all of them. We'll see where we get today, but thank you again. First, Mark, I want to start off with you. One of the listeners came in and is starting to re-gear their portfolio, moving away a little bit from equities, moving into holding equities and ETFs. Now, they're looking at kind of an overall ETF portfolio, and what does that really mean from an overall holdings perspective? Because they're initially holding 35 holdings. What do they get now from a diversification benefit when they start to put an ETF in there? And what if it was a pure ETF portfolio?
Sure. Thanks, Kevin. Well, I think what we have to realize is ETFs, by their nature, hold markets. So when you buy our ZCN, that means you're getting exposure to the Canadian market, 250 names. If you buy ZSP, S&P 500, you're getting 500 names. International, you're getting close to 1,000. Emerging, you're getting close to 1,000. So when you bring those ETFs together, those are the broad market exposures into your portfolio, you're immediately getting a diversified access, to, let's call it, 3,000 names in your portfolio. So you really, just by adding those, you've already completely diversified your portfolio. That doesn't mean you can't do others. The same thing applies in fixed income. Our aggregate bond will get you exposure to close to 1,500 bonds. But you might want to do some tactical things, some sector exposures, some factor exposures, some income exposures to tilt your portfolio. But when the question says holding 10 or so ETFs, absolutely, you're fully diversified. I'd argue you could go as low as 5, but depending on what you're looking to do, 10 certainly gets the job done, as I've explained. Thanks, Kev.
Well, let's do a quick follow-up on that, because another related question came in, but this one is more about the focus of income return versus capital growth. And what are the number of holdings? Does that influence the number of holdings there if you shift your focus?
It can, but it doesn't necessarily. So if you think of an income-oriented ETF, it's logically, on the equity side, going to look at things that have a higher dividend yield, or in our case, we've got our covered calls as well. So it's going to hold a subset of the market, but it's still going to be a very well-diversified portfolio, where some of our dividend ETFs, let's say our US, holds 100 names. So you're still getting that market-like exposure. Whereas if you're in a pure growth ETF, which I'll take to mean the broad market, you're going to get the whole market. So again, it's the US. If you look at the S&P 500, that's 500 names. If you look at the NASDAQ, it's 100 names. If you look at the Dow Jones, it's only 30 names. But regardless, in and of itself, your goal isn't going to reflect through to the number of holdings that you have, unless you're after a specific ETF that may be more concentrated. But by and large, you'll still end up very diversified. Thanks, Kevin.
Thanks, Mark. I'm going to keep staying with you. Hopefully put you in the hot seat here. Looks like a follow-up question from our NASDAQ webinar. We had two of them back about 2 months ago, had NASDAQ on. Now, this individual is looking for more cybersecurity and AI. Give me some background whether they're in the NASDAQ and where can people get those kind of exposures, Mark?
Sure. So the index of the NASDAQ is known for is the NASDAQ 100, which is the largest 100 names listed on the NASDAQ exchange, ex financials. So you end up with a very heavy tech weight, which of course gets you a lot of innovation and new economy, as well. You get some healthcare and a few consumer names. But that's very much a large cap portfolio. It's going to get you new economy growth, but if you're looking for emerging companies, cybersecurity, things of that nature, you're going to have to go a little bit beyond that. There is now the next NASDAQ, which is essentially the 100 after that. But there are cybersecurity ETFs like CIBR out of the US or HAC out of the US. Interesting names. And just for pure innovation, there's ARK, ARKK, lots of good US stuff out there. It's starting to come in Canada. I think you'll see that really show up in our marketplace as a reflection of the concentration of returns this year in equities. I think a lot of interest in this space. When I think cybersecurity, I do think of it as being, sort of disruption or innovation thematic, but perhaps it fits into a broader approach. Because if you go, just directly into that, that's probably a bit more of a trade or something you're looking to get in and out of, as opposed to a broader innovation approach or new economy approach. Thanks, Kevin.
Thank you for that, Mark. And time for one last question. Is really, let me get your general thoughts, because we know next week is that week it all comes together, I guess. Give me your thoughts in advance of the U.S. election, please.
Sure. Thanks, Kevin. Well, it's certainly pretty close right now. I know Biden's ahead in the polls, but just keep in mind the popular vote doesn't necessarily mean who will get the presidency, because of course that's going to be driven state by state, and we've got some key swing states that'll really push the election one way or the other. And then the other thing to keep in mind is, with all the mail-in votes, the results could be, a couple of months coming out, and it could get disputed. So that could cause some volatility in the marketplace. By and large, if we see the Democrats and Biden coming through, I think that's supportive of ESG. I think that's supportive of infrastructure. Probably some international type exposures if he starts working on repairing trade relations. If it remains status quo with Trump, I think it's more of a U.S. focus. Maybe some of the growthier NASDAQ type stuff continues to do well, or S&P 500, or our quality factor could do quite well there. And then if it ends up being split, I think there you want to have a bit of your risk off. So again, something like quality or maybe even our low vol type exposures really would do well in that space. So at this point, even though there is a clear leader in the polls, that doesn't necessarily mean that things are sewn up, and we certainly saw that back in 2016. So I think some caution is certainly called for here. Thank you.
Thanks for that insight there, Mark. And that's going to bring us to a close for today's session of Market Insights. I invite everybody to come join us next week, where we're going to talk about staying invested and follow up towards the U.S. election itself, depending where it is in the market. Who knows next week? I want to thank Todd and Mark for sharing their expertise today. Really appreciate it. Hopefully have you all back next week, Friday, November 6th at 1 o'clock. Thank you. Have a good week ahead.